This does remind me a little bit of the 1990 period, where we did see a spike in oil prices. We had Middle East conflicts. We had credit concerns that came as a result of the late 80s LBO boom. It was dismissed as yet another geopolitical, nothing to see here. And you did end up having both economic dislocations and market dislocations. Not extreme, not '08 like, but to me, there are shades of that 1990 period.
Today's episode is brought to you by Pictet Asset Management and their AI enhanced ETF range, ticker PQNT and PQUS. You'll hear more about how they're using AI to enhance equity exposure later in the show. For now, let's get into it. Very pleased today to be joined by Ann Sonders, Chief Investment Strategist at Charles Schwab. Ann, so great to see you. Welcome to Monetary Matters.
Nice to see you. I always love our conversations. Thank you.
Ann, you write recently that the 2026 period presents one of the most analytically rich internal market environments in many years, in part because headline indices are obscuring rather than revealing underlying stress. What is the stress you were referring to there, and how might it be obscured by the headline indices?
Let's just put some numbers on it first, and then I can talk about the why. So you've had, as you and I are taping this right now, we've had at the index level, the S&P's maximum drawdown so far year to date is 7%. So not getting really close to correction territory. It's a little bit bigger for the Nasdaq at the index level. The maximum drawdown has been 9%. But under the surface, it's where it gets more interesting. So if you look at the average member level maximum drawdown, so you go through, all the stocks in the S&P, look at what their individual maximum drawdowns have been, and then take an average. That's negative 17% for the S&P 500. And in the case of the Nasdaq, it's negative 31%. So you've had this rotation and churn where you get these pockets of weakness. Sometimes they're idiosyncratic with a couple of names. Other times they're specific to an industry like the software industry where you get, correction, if not bear market level declines. It's just offset by strength elsewhere. So rotation and churn has been happening, and it's masked by a more benign drop at the index level. Now, frankly, I think most investors would choose that kind of process where maybe you correct excesses, whether it's valuation excesses, sentiment excesses, maybe a fundamental narrative change through a process of rotation, as opposed to, say, the Nasdaq falling by 30% in one fell swoop. So it's not a bad way to go through this process, but it does tell you that the fuller story is told under the surface of these cap weighted indexes.
And we will get into the war and the impact on oil prices quite quickly. But, Ann, if I had run into you at a conference maybe in November and December, and we both knew that there would be an oil shock in the first quarter of this year, perhaps I might have speculated that the S&P would have been down more. The thinking being, okay, companies that aren't in the energy sector are probably going to be a little bit challenged. And even though the energy sector, is poised to do great with oil at 100 or perhaps even higher, the oil sector, just as a percentage of the S&P 500, the energy
Right.
sector, I should say, is just not large enough. And yet, as you say, the S&P 500 is, not nowhere close to down, in a bear market 20%. Why is that?
Well, I don't know that I would have speculated that we would have a bear market as a result of some sort of military conflict and a spike in oil prices. I think probably the conversation would have continued on in terms of what the actual mechanics were around the conflict, what the longevity of a move higher in oil prices. Where we sit right now, yes, I am a bit surprised that the market hasn't suffered a little bit more. But wait, what it may be reflecting is that there's pockets not just in the market, but also in the economy that are no one's immune, no industry, no company, no individual is immune from the impact of the spike in oil prices and how that filters through to inflation and the economy. But what we haven't yet seen is any deterioration in forward looking earnings estimates. Now, some of that is because we're just not at a point where analysts sort of have their feet put to the fire as you approach earnings season where they've got to actually take, eraser to the paper and say, okay, we need to make those earnings adjustments. I think as we get into the beginning of April and we're closer to reporting season, you might see those adjustments. In the meantime, we've obviously seen an upward bias to estimates for the energy sector, but we've also seen significant upward bias to the estimates for the technology sector. And I think that's combination of, well, maybe this sector is a little bit more immune to the military conflict, the war in Iran, and the effect of energy prices. But you've also had actually literally a couple of stocks that have pre-announced huge upside, and that boosted earnings. So I think if we had seen a more direct deterioration in the forward assumptions for that, you know, ever important factor of earnings growth, then I think the hit to the market would be more severe. Another reason that upcoming earnings season is going to be an incredibly important one.
If the price of oil stays at $100 WTI, it's a little bit lower, but Brent is at $100. If it stays around there, what do you think the impact will be on the economy, on the market, and how will it be the transmission channel? Will it be that companies themselves, like United or Delta Airlines companies, they are feeling the pinch, or is it that consumer sentiment and consumer savings and therefore spending is sapped by higher oil prices, and then through kind of a macro channel that impacts
Yeah, I
companies?
mean, I'd say to all of your, possibilities slash examples, the answer to all of them is yes. That is the feeder mechanism. I think in terms of global impact, there are unquestionably pockets of the global economy that are more directly and quickly impacted by the lack of oil getting through the Strait of Hormuz. Many Asian nations being a big part of that. You also see that reflected in the still fairly wide spread between Brent crude oil prices and WTI prices, WTI being the domestic benchmark. And in terms of overall, petroleum products, in the United States, we are a net exporter. That said, we are still a net importer of crude oil because of certain types of crude oil. So sometimes the follow on to that, we're a net exporter, is nothing to see here. There's no impact on the US economy. Maybe on the margin, less of an impact, but obviously it feeds through the consumption channel, through gasoline prices, through electricity prices, which were already elevated and a concern for consumers. You mentioned into travel, and it's not just airlines and the impact that that has on travel and people's willingness to spend. And that's not just at the consumer level, but the business level. But there's also, think about how much in terms of goods are transported in whatever form, over rail, over truck, over sea, that is impacted. So that feeds into consumer prices. We're not just talking about oil going the Strait of Hormuz, we're talking about petrochemicals, we're talking about fertilizer. Increased fertilizer prices feeds into higher food prices, which feeds into that consumption channel. Consumer sentiment or consumer confidence, whatever measure you're looking at, has already been pretty dour, never really sort of pulled itself out of the pandemic levels. The hard data has always been stronger. Consumption data has been stronger. Now I think we're clearly not likely to see a pickup in consumer confidence, but we could start to see more of a reining in on the consumption side. So the longer it lasts, the more it turns into a demand, overall economic demand destruction story. If you wanted to find something good about that, it probably lessens concern that has crept in recently that the next move by the Fed might actually have to be a rate hike, not a rate cut.
That the fact the prospect that the Fed is going to hike rather than cut interest rates has increasingly been priced into the market.
Yeah.
What do you think about that?
So I think it's premature. That said, the Fed is operating with being data dependent, and unique among major global central banks is the dual mandate that the Fed operates with. And right now, the two sides of their mandate are in conflict with one another. We've seen weakness show up in the labor market, even in advance of the war in Iran. But we've also seen upward pressure to inflation, particularly the inflation metric that the Fed pays most close attention to, which is personal consumption expenditures, the PCE measure, both at the headline level and at the core level. So there was already discomfort in inflation not coming down to the Fed's target, and that predated the war in Iran. And then, of course, you've had the most recent Fed meeting. No surprise that they didn't do anything. They certainly didn't telegraph rate hikes, but that's what started to get priced in, especially with the recent intraday spike on the part of Brent oil up to close to 120. I think that really kind of rattled a lot of market participants, and you took those expectations of cuts fully off the table, and maybe a concern that a hike might have to be considered.
Quite often, particularly in 2022, the stock market responds and cares very much about what's being priced into the Fed fund futures and the bond market. But as you've been pointing out, the real driver of the market since the war started in late February has been oil prices.
Yep.
And you show the intraday correlation between Brent crude and the S&P 500 has been very negative.
Yes.
So how much of the S&P 500's market returns over the past month have been kind of a one-way bet in the opposite direction on the price of oil? What does that say about where we are right now?
Other than a day this week where you had a big rally in the market, in part because you had a 10% drop in oil prices. So that intraday, rolling intraday, very steep inverse correlation, I think, is going to persist, and that of course means you get the benefit on the upside for the equity market to the extent you get some downside in oil prices, and vice versa. And it's hard to see what breaks us out of that inverse correlation historically, even as recently as the first 2 months of this year. I know you referenced the intraday correlation. I'm sure you've seen the chart. You had fits and starts at times intraday. There was a positive correlation, negative correlation. That wasn't because the two markets were trying to figure each other out. It just there were a million other things going on, and the market wasn't keying off of oil prices that had been just kind of hanging around, $60 ish per barrel in WTI. So on certain days, it happened to be a positive correlation. Certain days, it happened to be a negative correlation. It was almost more arbitrary. Now, clearly, we're seeing that impact. And I think what's sort of reinforcing that or maybe exacerbating that steep inverse correlation has to do with the mechanics of the market in this type of environment. You've got traditional retail traders that's distinct from individual longer term individual investors, but retail traders now account for about 25% of trading volume. Then you add in other what I've been calling short attention span money. So systematic hedge funds, the CTAs, which is commodity trading advisors, long short hedge funds, all operating with pretty minuscule time horizons and kind of playing the other side of positioning. And you get these really swift moves that sometimes can turn intraday on a dime. It is a tricky environment. There's no question about it.
Lizanne, I know you prefer to analyze things from the lens of factors rather than sectors. So I'm going to get to that in a moment about factors. But if we could just stick with this sector thing, you got this great chart showing how the year-to-date performance of the energy sector has been over 30%, and meanwhile, other sectors have struggled massively, and the percentage of energy companies that are over a 50-day moving average is 100%, as opposed to in the industrials, it is something like 13%. So that does not inspire a whole lot of confidence. How are you thinking about the energy sector, which does appear as kind of the ultimate hedge for what's going on?
Yeah, so we have a sort of a range of views at the sector level from, the least favorable to the most favorable. And energy kind of falls in that sort of high neutral to somewhat favorable range. Our time horizon when we express views at the sector level is in the 6 to 12 month period of time. If I was a trader and I was talking to you now about the energy sector, I'd probably be a lot more optimistic. Having a more reasonably long time horizon, given what has been a pretty significant amount of outperformance and almost parabolic nature of the move, I think you have to be a little bit careful there. So a lot of it is sort of the context of time frame and time horizon. And we do publish sector views. Schwab has sector views. You can literally just Google Schwab sector views, and you can see where the scale is on all the sectors. We've had a favorable view in areas like communication services, also industrials. Our least favorable has been more in the real estate and the consumer discretionary. But when I talk about factors, I think it should be at least as an overlay to what is a more monolithic sector recommendation. When you have a highly correlated market and you have an era like the Mag 7 being sort of the only game in town, monolithic investing made sense. You could buy, a cohort like the Mag 7, or you could buy tech because stocks were highly correlated within the tech sector. Now we're in an environment, notwithstanding the last month with the onset of the Iran war, but you've seen correlations break down, dispersion go up, and even within a single sector, a much wider array of performance, which the factor based analysis is just applying. Factors is just another word for characteristics. So instead of just making a monolithic call, look for certain characteristics within any of the 11 sectors. And there's been more consistency in terms of performance at the factor level than there has at the sector level. Sectors kind of swing wildly on a week to week and a month to month basis.
And what has been the factors that are causing that dispersion? If you have sector X or sector Y, and you have the top performing stocks in that sector versus the bottom ones, what factors explain the outperformance? Is it value? Is it quality, momentum, or what
Yeah.
else?
So interestingly, let's just talk about the past month because that seems to be in focus for a lot of people, given the change in market behavior in light of the war in Iran. And one of the better performing factors, interestingly, and this goes again back to the dominant players in the market and positioning, has been short position, meaning some of the best performers have been the stocks most heavily shorted.
Hmm.
And that's in part because some of these really short term traders, including retail traders, are back to some degree in that, meme stock era 2020 mindset that's almost, stick it to the man. They're thinking, how do I play the other side of the trade? Look to where short interest is high and make a bet on the necessity of short covering. So they're inherently a lot of the other characteristics of heavily shorted stocks tend to be lower quality, weaker balance sheet, or lower interest coverage, or maybe higher valuations. But in an environment like this, where there's so much flip flopping happening in terms of positioning, you'll get a move like that that is arguably lower quality if you're thinking in a traditional way, but it's easily explained by what's happening. You see it not just in the equity market. Gold was on an absolute tear prior to this. You would think an asset class like gold would do incredibly well when you're at the onset of a war, you're in a military conflict, that flight to safety and protection. But the more recent move up in gold had gone parabolic. It was very much driven by performance chasing and FOMO. So now you're sort of getting traders playing the other side of that. So it's less about fundamentals and more about technicals. So that's a way to think about factor investing in this environment. We still think you want to have a quality focus, but the quality component that we think is most important now is profitability. In fact, another thing that's happened that's a very important difference between this year and last year, to just put it in kind of calendar year terms, is within the Russell 2000, which in the past year, notwithstanding the last month, really had quite strong performance. But within the Russell 2000 in 2025, non-profitable stocks were up 20%. Profitable stocks were up only 10%. So double the performance by the non-profitable stocks. That has flip-flopped this year. And now it's the profitable stocks that are handily outperforming the non-profitable stocks. So I think in this environment, if I would say sort of one category of factors of focus for us is that profitability. Not just simple, forward earnings, but stability in profit margins, a positive outlook positive earnings revisions looking ahead. So that's the area of factor focus that we have been resting on recently.
So the highly shorted stocks, because hedge funds short them, tend to be the ones that have lower profitability, perhaps are losing money,
No,
or
no,
that
no.
they
Last
perform well too.
year, well, I was talking about profitability in terms
Okay.
of last year versus this year. So leaving short interest aside, separate from that, what I was talking about is within small caps, last year was a story of low quality, given that the unprofitable components or constituents within the Russell 2000 had twice the positive performance as the profitable constituents. Complete opposite this year. This year, the profitable constituents within small caps are handily outperforming. You would think that that would generally be the case.
Mhm.
It was not the case in a year like last year.
Sorry, it's interesting about the heavily shorted thing, because I think what at it, if you were telling me, the only thing you told me was that highly shorted stocks are outperforming, I would say, oh, that reminds me of 2021, in terms of kind of a speculative excess, a very very strong bull market. But it's interesting that in the challenging market we've had over the past month, that highly shorted is performing well as a factor. That's fascinating.
Yeah, that's why I think one of the things that this reflects is when you think about kind of the retail trader cohort. I, I don't want to generalize and say they're not paying any attention to macro stuff, but they're paying less attention to the stuff that we all live, eat, and breathe on a day to day basis. Concerns about geopolitics and the war and the impact of energy prices and the feeder into inflation and what's the monetary policy reaction function and how does it hit the consumer. It's much more of a sort of blinders on what is my trading strategy today, um, which at times can adjust based on narrative changes from a more macro perspective. But that's not really the primary driver on a minute to minute, hour to hour, day to day basis for many of these trader cohorts.
So, would you characterize yourself as a perma bull on quality? In other words, the companies who are, perhaps processing payments on credit cards have a higher profit margin than the banks who are making the credit card money. If you're an oil company, and you have a royalty, all you do is own land. You have basically very very little costs. You're going to have higher profit margins than the companies that have to plow billions of dollars into the ground to actually produce the oil. So you'll be higher quality. Those types of companies have outperformed over time. Would you characterize yourself as almost all of the time you are bullish on the quality factor, or is there you time it?
Not really. So yes, over the very long term, do the stocks of higher quality companies outperform lower quality companies? 100%. So if we're talking, 5, 10 year time horizons, yeah. But there are really important times where actually going down the quality spectrum, whether it's to weaker balance sheet companies or companies that have, lower interest coverage that have lost their profitability, there are times where there's a benefit in doing that. And in particular, it's when you've gone through a significant downturn, call it a recession, and the market starts to price in the recovery coming out of that. That is where the leverage is greatest, often where the pain has been most acute. So there are times when you're at sort of one of those potential economic inflection points. A perfect example of that would be in 2021 when we saw the creation of vaccines. The global economy started opening back up again. The market suddenly said, we're not in this sort of closed environment anymore. We can now start to price in whatever recovery out of a pandemic looks like. And you saw a willingness on the part of investors to go down the quality spectrum in areas and stocks and industries and types of companies that were most damaged. Because now, when you had the opening up, they had that opportunity to see that improvement. And what I the overarching message around that is a mantra I always share with investors when I talk very big picture and try to get people to understand at times what seems to be a disconnect between what's going on in the economy and what's going on in the market, is that better or worse often matters more than good or bad. And as a leading indicator, the market tends to sniff out inflection points. And if you think about economic inflection points, at the bottom, when things have stopped getting worse, in anticipation of them starting to get better, at that moment in time, the data is at its worst. It looks awful. That's why, launch points of new bull markets have often typically come when the economic data looks horrific. It's because the market is sniffing out that things have stopped getting worse and starting to get better. Conversely, at the top of the V, when economic data stops getting better, starts to deteriorate, but before the deterioration actually happens, you take a snapshot and the economic data looks absolutely fabulous. Yet, through the benefit of hindsight, we can say, boy, tough to have called a bear market starting then because look at how great the data was. Better or worse tends to matter more than good or bad.
So at the beginning of a bull market, at the trough of the business cycle, when it's about to, it looks like it's going to be the worst, but it's about to get better, that's when you want to own lower quality companies. So, not load up on the quality factor. Does
Well,
the,
I don't want to say throw out
yeah.
quality and just load, but that's a time when there's opportunity that presents itself down the quality spectrum. It's not a throw caution to the wind, do some quality screen, turn it upside down and just buy, the 10 at the bottom of the barrel.
So what the fact that you really like the quality factor now, what does that indicate about your overall outlook? Could it accurately could it be called, kind of a defensive posturing?
Well, interestingly, I think this is a market cycle that we have to that we should maybe think of what's defensive in a different way. So I think defensive often suggests, consumer staples and utilities. There's this sort of direct link that people make between what's defensive, okay, what types of stocks and what sectors do they live in. Defensive is almost more of a concept and can mean different things at different times. Go back to the pandemic. Think about 2020. Call it just the first year of the pandemic when the entire global economy was completely shut down. The the only ecosystem in which we were all living, we weren't traveling, we weren't shopping. The only ecosystem was represented by the mega cap tech companies because that was the world in which we were living. That was still operable. That was how we communicated. Those became that era's defensive stocks. That's where you went for defense, lowercase d. And I would say the same thing about momentum. This is what trips investors up too. They think of defensive as automatically meaning, consumer staples and utilities, and they think momentum as meaning, oh, it's just tech stocks. Momentum is also just kind of a concept. Um, Momentum just means that stocks that have been doing well continue to do well. There can be momentum in consumer staple stocks. There can be momentum in utility stocks. It just means that there's momentum in what's been working continues to work. So I think that's examples of some of the almost factor-oriented terminology that can sometimes trip investors up. I think that, again, we're starting to see just in the past month that maybe some of those mega cap tech stocks are displaying a little bit of that defensiveness, which is not your classical area of defense.
I hope you're enjoying today's interview. As soon as AI tools began to wow the world, investors started asking, when will AI-driven strategies become more common? The answer is that they already are. Sophisticated quant hedge funds have been using machine learning strategies for many years, largely only for the benefit of institutional investors paying higher fees. Now, with the barriers to usage coming down, AI machine learning approaches are being made available to you through Pictet's AI Enhanced ETF suite, including the Pictet AI Enhanced International Equity ETF, ticker PQNT, and the Pictet AI Enhanced US Equity ETF, ticker PQUS. PQNT seeks to deliver enhanced international equity exposure, while PQUS seeks to provide US equity exposure, both aiming to uncover potential sources of outperformance that may be difficult for human investors to detect or explain. And unlike many other active ETFs, they aren't just taking factor risk, leaving you overexposed to specific sectors and betas or style exposures. Instead, they help neutralize factor exposure to minimize index tracking error. That means if they outperform, it's coming from true idiosyncratic stock returns, not excessive risk or factor exposure. To learn more about how you can harness the power of AI in your portfolio, check out the link in the description. Investing involves risks, including the possible loss of principal. Because these ETFs rely on an AI-driven model, the strategy may not perform as intended. International and US investments may involve additional risks such as currency, political, or regulatory developments. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, which may be obtained by visiting www.pictet.com/ETF. Read carefully before investing. Distributed by Foreside Fund Services. Thanks for listening. Let's get back to today's interview. So the mega caps are indicating a defensiveness, meaning that they are going down less than the market, or what?
Yeah, well, we've seen a little bit more interest back in tech up the cap spectrum, but that also had to do with that's where some of the pain points were most significant. So if you're sort of trying to pick off what has underperformed to a significant degree. I mean, look at the turn that the SaaS stocks, the software as a service, got absolutely hammered during that sort of era, that mini era that predated the start of the Iran war when everybody was focused on the AI disruption story. Absolutely crushed those stocks, such that positioning was so washed out that you got almost sort of the reversion to the mean trade. So I think there have been a lot of aspects to what we're seeing, what's working well, what's not working well. That in the case of energy working well, that's sort of a big duh. When you've got a huge move up in oil profits, that adds to the profitability of the energy sector. But in other places, you get a combination of, well, maybe I can hide out in these names that are seen as less impacted day to day by higher oil prices, or maybe it's time to trim where I have profits. If I feel consternation about the market and I'm a little concerned, maybe I should take profits where I have profits. And, the trader mindset, boy, what's been so damaged that maybe I can kind of pick that off for a move on the upside. So I think it really depends on the investor and their time horizon as to what's driving where they're finding interesting opportunities, both on the buying side and the selling side.
Liz, and I loved, I think we did an interview in 2023. You pointed out to me how, everyone thinks of the growth as a factor. So a growth fund as having tech stocks because tech stocks grow their earnings. But the sector that grew their earnings the most in 2022, or one of the most, was energy. So you had the growth index dominated or having higher share than normal of energy companies in 2022, just to show how kind of malleable the factors are, not in terms of what they
Well,
represent, but
not
in
only that, but
composition are.
the indexes so labeled have different index providers have different rebalancing dates. So S&P, which has their S&P Pure Growth, S&P Growth, S&P Pure Value, S&P Value, those are the four growth and value indexes created by S&P. S&P does their index rebalancing in mid-December every year. Russell 1000 growth, Russell 1000 value, 2000 growth, 2000 value, they don't do their rebalancing till the end of June every year. So exactly to your point, Jack, at the end of 2021, mid-December, S&P rebalanced their indexes, and S&P Pure Growth went from having all 8 of what at the time we called the MegaCap 8. So it was the Mag 7 plus Netflix. It was kind of a different cohort at the time. Poor Netflix just got pushed aside, and then we all became obsessed with the Mag 7. But all 8 of the MegaCap 8 were in S&P Pure Growth on December 18th. On December 19th, when S&P did its rebalancing, only one was left in Pure Growth, and the other 7 were then split between S&P regular value, S&P regular growth. And to your exact point, because of that, tech overnight went from being 37% of S&P Pure Growth to only 13%, and energy became the highest weighting. Russell didn't do their rebalancing till the end of June. So for the first half of 2022, you would think S&P Pure Growth and Russell 1000 Growth, we're both talking about large cap growth indexes, would look fairly similar. They didn't look at all similar. And by the way, by the time Russell did their rebalancing, energy's growth rate had started to come down. Their rebalancing didn't lead to a significant weighting increase in energy. And even by the end of the year, you had a huge performance spread. So when I hear people generically just say, "Oh, I like growth," or "I like value," or "I'm going to be invested in," or "overweight," I always want to I beg to ask the question, are you talking about the actual characteristics of growth and value, regardless of where they're housed? Are you talking about the indexes labeled growth and value? And if you are, you better understand what sits in those indexes, because not all growth indexes and not all value indexes are created the same. Or are you thinking in growth and value and preconceived notions? Oh, tech stocks are always growth stocks and utility stocks are always value stocks. Well, there can be growth in value stocks. You can find value in growth stocks. So I always think about growth and value based on the actual characteristics, and I don't put blinders on in terms of just index labels.
So what does growth look like right now?
So, overall, sort of S&P 500 earnings growth looks great still. We had about, depending on whether you're looking at, FactSet numbers or LSEG IBES numbers, call it, 14-ish% earnings growth for calendar year 2025, and actually a bit higher than that expected for calendar year 2026. Um, as I mentioned earlier, estimates for 2026 have actually been rising over the past month, which surprises a lot of people given all the uncertainty with regard to the war. But as I mentioned, it's mostly concentrated in upward revisions to the energy sector and the tech sector. I think we still are going to get some downward revisions as analysts become a little bit more kind of fine tooth comb when we get to the end of the quarter. But maybe what's really important is that when we talk about how's growth, how's earnings growth, we often just hone in on the S&P 500, and that is the kind of a proxy for the economy, and it's obviously the most dominant benchmark for U.S. equities. But it's 500 companies. What's maybe interesting and helps to explain why there's sort of much more of a dour mood on the part of consumers, small business confidence being more dour than, large company confidence, is that if you look at all profits in the US, all US corporations, Fortune 500 companies, sole proprietorships, S corps, and by the way, you can track that via a profitability metric that gets reported alongside GDP.
Hmm.
We don't yet have it for the fourth quarter because this particular metric, which I'll mention in one second, when we don't get for year end until the final read on fourth quarter GDP, which will be next month. And then we'll get an update to what's called NIPA based profits. NIPA is an acronym standing for National Income and Product Accounts. It's millions of companies. It's tracked on a quarterly basis. Again, it is publicly traded companies, private companies, huge companies, tiny companies. It's the whole kit and caboodle. Well, and we only have 3 quarters of data for it right now, so we're not doing apples to apples here. But in the first 2 quarters of 2025, when S&P profits were up, comfortably in double digits, NIPA-based profits were negative both quarters in a row. We had a mild pop up into positive territory in the third quarter. We don't yet know what the fourth quarter, but a tale of two very different sort of earnings stories, depending on whether you're talking about an index like the S&P, which is very large cap, growth oriented companies, and corporate America.
So does that suggest that companies that aren't in the S&P 500 are not having an amazing time?
Oh, no, not necessarily. There's tons of NASDAQ stocks that have done extraordinarily well. The 10 best performing stocks in the NASDAQ last year, I'd never heard of any of them. There's plenty of opportunity. The point is that you can't look at S&P 500 earnings and say that is the entire profile of corporate earnings in the United States. That's not to say that the only game in town from a performance perspective, and that's another mistake that I think investors make, is they think the only game in town is, you know, a cohort, say, like the Mag 7. Certainly in years past when they were the biggest contributors to S&P returns. But here's some important numbers to illustrate what I'm talking about here. Is last year only two of the Magnificent Seven outperformed the S&P itself, and that was Alphabet and Nvidia. Alphabet actually was the best performer among the Mag 7. It was the 75th best performer in the S&P 500. Nvidia was the number two best performer of the Magnificent Seven. It was also the number one contributor to S&P returns, but it wasn't even in the top 80 of best performers. So too many investors conflate contribution to index returns, which come partly as a result of the multiplier of your cap size. In a year like this, up until very recently, it's been working in the opposite direction because now we only have one of the Magnificent Seven outperforming the S&P. All the other stocks are underperforming to a meaningful degree, and now you're multiplying underperformance by a huge cap size. The real point of all of this, there's plenty of other fish in the sea. Individual investors that are not like a fund manager, they're not benchmarked to the S&P 500 on a quarterly basis. They're not at the mercy of the construction of these indexes. There's lots of fish in the sea and there's lots of opportunity. And sometimes we get in this mindset of thinking the only way I can do well is to be in, you know, the Mag 7 or the mega cap tech stocks. There's plenty of other opportunities to do well without taking that concentration risk.
So 14% earnings growth is what's priced for the forward S&P.
No, it's actually closer to like 16 or 17
Oh,
right
wow.
now for 2026. 14 was about what calendar year 25
Okay,
actual
that's very
earnings
high.
were. Yeah, yeah, no, very high, and still historically high profit margins without much deterioration at all in forward estimates for profit margins. That I think is going to be the big sort of open-ended question that we'll all be asking during first quarter reporting season, which will start, second week in April, is all right, can we rely on these lofty assumptions, or do we have to start adjusting our thinking about the ability to maintain historically high profit margins?
What about the constituents of the, whether the growth indices, whether it's S&P growth or the Russell growth? Just as in 2021, 2022, how some growth indices, which you think of, oh, they have tech stocks, actually had a lot of energy. I mean, do you think that the energy stocks will start to enter the growth indices just because that's where the earnings growth is, as
Well,
well
it
as
depends.
your view on
It
the growth
depends
factor
on
right
how long lasting the move higher in oil prices are, and the extrapolation length associated with higher earnings. If you're just seeing analysts do, a 1 or 2 quarter adjustment to estimates to reflect, $100 Brent, $90 WTI, I don't think that's going to work its way into a massive rebalancing, say at the end of the year for S&P in favor of energy stocks to the same degree that existed back in that late 2021 period of time. But the longer we see oil prices elevated, when we already talked about the ripple effects into inflation, into monetary policy, into consumer spending, into profit margins, and to costs of things, et cetera, then you could start to see analysts pricing in more longevity to that pickup in earnings for the energy sector. So it really does mean figuring out what the timing of this war is going to be. I'm not going to venture a guess.
And so you have a bullish view on the quality factor as we sit here right now.
Well, I want to say both of you on the quality factor. Quality is not sort of a singular factor. There are factor classifications that are really broad, whether you might say quality, but I think of quality as a wrapper of a number of different factors. Higher return on equity versus lower return on equity, stronger balance sheet versus weaker balance sheet, either low debt or high interest coverage versus low interest coverage, you know, uh, positive earnings revisions trends, stability or improvement in profit margins. I would put the quality wrapper around multiple factors.
And of those kind of mini factors that contribute to the broad quality factor, the one that you are a bull on is high profitability.
Yeah, I think profit, sort of visibility of profitability, not necessarily just, you know, find the stocks with the highest growth rate, but that visibility, that stability in profit margins, looking forward. I think that is where an important factor focus should be.
And if I
But
were to
but
ask,
also balance sheet factors. I think in an environment now where the Fed has stepped back from easing policy, and there is now a risk, valid or otherwise, that the Fed might have to consider hiking, that I think that's part of the reason why small caps have come under pressure very recently, because a big part of the lift last year to small caps was when the Fed embarked on an easing campaign. That lowers borrowing costs for smaller companies that tend to borrow via more traditional channels. They don't have as much access in the kind of private credit area. If you're pricing in an environment of kind of higher for longer, then things like interest coverage as a factor should be another area of focus.
want to ask you about private credit in a moment, but if I were to ask you your views on the value factor and the momentum factor, both the broad, sort of wrapper as well as the the contributors to the wrapper within. So obviously, value has like price to book, price to earnings, but are any of those things on which you have a
Well,
view?
so again, value is sort of a wrapper. I actually think if I wanted to um, sort of quantify with a word the grouping of factors that I think makes sense right now, it would bring in an old school uh, acronym of GARP, growth at a reasonable price. I think this is an environment where you don't want to look for growth but sacrifice value, and vice versa. I think this is an environment where, as we already mentioned, you want to look for that visibility in terms of profitability, stability in profit margins without paying exorbitant multiples, whether it's, P multiples or price to book. So that would be kind of that GARPy, growth at a reasonable price. As far as the momentum factor, momentum again is more of a concept. It just, if momentum as a factor is working, it means that the stocks that have been working continue to work. But there's different measurement lengths associated with momentum factor. So firms that do factor analysis and they track factors that go to a more granular level will do different time horizons associated with factor, like a 1 month momentum, a 6 month momentum, a 1 year momentum. So I think momentum will probably work, but probably more the short term momentum. Things that have been working for the last couple of weeks or maybe a month might continue to work. I'm not sure whether longer term, call it 1 year momentum type factors, are what you want to focus on in this particularly unique period of high amounts of not just uncertainty, but instability.
Thank you. Liz, and I've been talking to some oil analysts, been reviewing other oil analysts' work. It seems to me like they have some pretty extreme concerns about the price of oil. And I'm sure you've been reading this work too. How do you interpret the quite dire analysis of specialists in supply chains and oil, just showing how the current supply demand imbalance is perhaps the greatest in history. How much, on the one hand, is that a true concern? Versus, on the other hand, so often in the history of investing, there are things that seem like they're a true crisis, and actually that is a buying opportunity.
Right. I would say, wouldn't surprise me if ultimately the answer is somewhere in between. I have tremendous sympathy for the higher for longer view on oil, even in an environment where you see de-escalation, whatever the heck that looks like, and whatever form it would take, and whenever that would happen. Because what we're talking about here is literally a choke point that doesn't have alternate routes through which 20% of all global oil supplies flows. There is no alternate route. It's very different from what we've seen in the past, where you get, a quick supply disruption, a spike in prices, and supply chains can kind of somewhat quickly adjust. That doesn't exist here. In fact, it's the only sort of oil and petroleum products as well as LNG choke point that doesn't have alternative routes. As a result of that, what's happened in light of very little traffic getting through is storage facilities filled up to the brim. And as a result of those being filled, production got shut down. That is not something you turn back on very quickly. When you see how much the fertilizer industry is being hurt by virtue of this, if the strait opens back up, that doesn't help farms that haven't had the fertilizer they need. That takes time. So I that's why I think this idea that when hostilities end that we'll see an immediate snapback to $60 oil, that story makes very little sense to me. Um, you could see from maybe a trading perspective that might happen, but to me, the more likely scenario, and like you, I pay a lot of attention to the experts in this area. I'm not an oil expert, so I also have to rely on energy experts, and I think that this is quite unique. This is somewhat similar to the pandemic in terms of what it exposed as it relates to the lack of diversification in the supply chain. Obviously, different beasts, the pandemic versus this, but it represents an extreme in terms of supply dislocation that cannot be fixed quickly.
Do you think that this is going to cause increased volatility in the stock market? There's been increased, tremendous realized volatility in the commodities market, the oil market, as well as implied volatility in the stock market. But
Right.
the realized volatility in the S&P has been not
Right.
too extreme, right?
I think more likely we continue to see subsurface volatility, as witnessed through lots of rotation and churn under the surface. I think that, to me, which has been the backdrop for the past, and it's not just the past month. This sort of I've been saying that the momentum trade has become rotation. Like a lot of momentum traders, that's what they're playing right now, are these rapid fire rotations and trying to get, kind of on the right side of these rotations. I think that's where we will experience continued volatility, not necessarily picked up in those traditional broad market volatility measures.
Earlier, you referenced private credit. Uh, Interestingly, it's not the borrowers of private credit that are experiencing some volatility in the markets, but the actual lenders, the companies that
Right.
aggregate the cash, raise the money, and then deploy those to public as well as private vehicles. Could you summarize, for our viewers, how just the facts of what has gone on over the past 2 months, as well as share your view?
Well, so really important, essential caveat. This is not my bailiwick. I'm not a private credit analyst. I don't have expertise in private credit. That said, it has become an obvious sort of touch point for the market, a cause of consternation, a cause for volatility and weakness, even in the public markets, among the stocks most directly tied to concerns about private credit. And maybe I'm giving myself the ultimate wide berth here in saying that so far the disruptions that we have seen, some of the defaults kicking in and concerns about questionable lending practices and gates getting shut, liquidity concerns, the Jamie Dimon comment. Anytime he opens his mouth, it's splashed all over the front pages, maybe rightly so, that once you see one cockroach, and we've seen more than just one cockroach. We've seen now a handful of cockroaches with some failures and some serious concerns about lending quality and practices. But I think we're shy of it looking akin to a 2008 systemic kind of takes the entire financial system down with it. You know, More than a couple of cockroaches to 2008 systemic crisis, the answer being somewhere in between. Yes, I'm giving myself an incredibly wide berth. I'd say what to watch would be traditional credit spreads, which have started to increase, but are not sort of screaming a dislocation that would be suggestive of a 2008 systemic kind of crisis, at least as of now.
Is I remember interviewing your colleague Kathy Jones, specialist in fixed income, and she
Yes.
struck a note of caution on private credit. Um, this was several years ago. Yeah, I wonder. Other analysts have pointed out that high yield spreads remain somewhat low, even though they've picked up, but the sort of implied yield of private credit is so high, and that there's a pretty wide dispersion there. So there's the asset case of are these loans cockroaches? Are they going to cause trouble? And then also the liability side of just people kind of withdrawing their money. And I think it is on people pulling their money. That is kind of what the center of.
Yeah, but there's also,
Yeah.
there's also a little bit of a macro story here too, as it relates to AI and the build out associated with that. So, a couple of years ago, again, if you're going to just pick on the cohort that is the Mag 7, because everybody's familiar with what that represents and what stocks sit in there. 2 years ago, free cash flow growth for the Mag 7 was running at more than 60% year over year. That's now in negative territory. More and more sort of CapEx is now being funded via debt deals, not just funded out of cash flows. So that's a different dynamic that exists right now. And you see, what became one of the poster children of concerns about too much debt being, Oracle and the stock price getting hit and credit default swaps, going through the roof. And I'm not an analyst of individual companies. I just mention it because it became sort of the poster child. I don't have an opinion on the stock, but so I think it's that also broader AI. Where are we in the AI build out? Should we be at least as focused on what it's disrupting, but also how financing is being done, especially given concerns about the circularity of financing? When that was financed out of earnings and strong cash flows, that was a different story than when more of the financing happens in the debt markets.
Yes, again, not commenting on any individual company, but I think if like a Facebook or Meta doesn't pay back its private credit deal, there's gonna be so many problems in the world. You know what I mean? I think also a lot of these private credit concerns is because a lot of these were direct loans to private equity backed
Right.
software companies, and the software companies are going to be disrupted. And in the public markets, the software equities have absolutely
Oh,
plummeted like a
plummeted
stone. And
until recently, and then they've had a pop, which may not be all of a sudden the prospects for that industry improved, but it got washed out, and there was so much money that had moved to the sell side, short side, and you get kind of a reversion to the mean move that isn't necessarily because all of a sudden the fundamental support case changed. It was probably never as dire as what the stocks reflected, and maybe the move back up isn't fully reflective of some miraculous shift in the outlook for this group of companies.
and Lizanne, you and your company, you sit at the intersection between a lot of institutional investors and retail investors. Private the LPs, the investors in private credit funds, historically have been extremely large pools of institutional capital. The endowments, insurance companies,
Right.
the charitable trusts, and such. And they are totally fine with having their money locked up for many years. Increasingly, a lot of these alternative asset managers have raised money from through retail channels, so wealth
Right.
managers and the like, with the similar gating type functions. And I think it is good for stability that these gating things exist, so that you don't have a kind of run on the bank.
Run on the bank, yeah.
Yeah. Do you think that this individual retail investors, whether individually or through a wealth manager, do you think they will be able to accept the lack of liquidity that
So
Harvard and Yale have historically
that's
accepted?
that's an incredibly important question, and the question that any advisor working with a client should be asking. The most important component of this heightened interest on the part of individual investors and the further democratization of private markets and providing that access to individual investors is the education associated with it. That's certainly, as a firm for the past 53 years, been our bailiwick, is making sure we are educating investors so that they understand How does, whether it's private credit or private equity, how does it fit in your portfolio? How is it correlated to other asset classes in your portfolio? What is the time horizon associated? What is your risk tolerance? What is your need for income and liquidity? What is the willingness to give up some of that liquidity and in turn transparency? So all of those questions, they need to be seriously discussed with the investor who wants to embark on investments in the more opaque world that is private markets.
Does the Magnificent Seven, and I suppose I'm really asking about the hyperscalers that are investing hundreds of billions of dollars of capital to build out data centers and power AI, do has their quality factor decreased? Because historically they were enormous cash generation machines, very large cash from operations, and that they were able to deploy to dividends, buybacks, as well as just cash in the bank. Now they're really spending money, and in some instances, free cash flow is declining quite rapidly, and forward estimates of free cash flow are perhaps negative. Um, does what do you say
Well,
about how that impacts their quality?
again, quality as an umbrella or specific quality factors. So, free cash flow is a factor, and that that's changed for many of the hyperscalers. They went from being massive free cash flow generators to less so, at least in the aggregate. Um, but other sort of quality growth oriented metrics, the earnings trajectory is still fairly lofty, and even valuation oriented factors to some degree have actually improved because you went through this period of underperformance while the earnings trajectory wasn't commensurately deteriorating, such that you actually, peeled off a few multiple points in the aggregate, making the valuation piece look a little less concerning. So I but I don't want to take it any further step from there because that's when you get into individual kind of companies, which we do at Schwab. We have Schwab Equity Ratings. We rate 3,000 domestic stocks. We do a GPA. It's ABCDF. So
Okay.
anybody that has any interest can look up what, is it an A-rated stock, a F-rated stock, or something in between. So my analysis stops. It's even fairly uncommon for me to be talking in cohort terms of a group represented by only 7 stocks, but it's an occupational necessity given the interest in a cohort like that.
Liz Ann, I believe before the war started a month ago, international markets, so non-US markets, had been outperforming US markets.
Yep.
What did you think of that narrative? Did you buy that narrative before the war started? What do you think of that narrative now? Given the fact that obviously $100 oil, higher oil than that, isn't going to help the US, but it is a little more insulated than other, particularly emerging market countries that are in Asian countries that are giant importers of oil.
Yeah, our positive outlook for international markets actually dates back to October of 2022 when we came to the conclusion of that year's bear market in stocks. And as we started to see the recovery and a new bull market was starting, we very consistently express the view, not dump all your domestic stocks and back up the truck and load up on nothing but, MSCI EFA and MSCI EM, but that this was a time you didn't want to shun international diversification. And so that was our view for the past couple of years. And more recently, given what was, and by the way, up until the war began in Iran, both MSCI EFA and EM were outperforming the S&P for the past 2 years. It wasn't just a very recent phenomenon. But we always caveated with that doesn't mean, again, you get rid of your domestic exposure, that international outperformance is not going to be linear. It's not going to be every week and every month and every quarter. Our message was more about don't shun international diversification more so than this is a no brainer. International is going to consistently outperform domestic. That is still our view, but clearly there's been a shift back toward a domestic focus given the war and the disproportionate economic impact of higher oil prices and the closure of the Strait of Hormuz has on non-US markets, not to mention the fact that we had been in a downward trend in the US dollar, accruing to the benefit in particular of emerging markets. Now, throughout the course of the war so far, we've been on an upward trajectory in the dollar, not accruing to the benefit of international relative to the US. How long the war lasts, could help answer the question as to whether we continue to see that shift back to a domestic bias.
Liz, and I'm sure you've seen the folks saying this. I'm curious, what's your reaction when analysts make that table of 10 historical geopolitical wars, and 5 years later the returns were great, basically showing that the historical record shows that geopolitical chaos doesn't harm equity returns as much as people might feel at the time when it's the strong
If it
concern.
doesn't turn into protracted conflict that causes sustainably high oil prices that has a feeder into economic growth. That's always, should always be a caveat. Yes, many of these sort of military conflicts that have been short-lived, even if they turn into longer dated military conflicts like Russia, Ukraine, if it's not sustainably high energy prices as a result of that feeding into recession risk going up, then they tend to have a short-lived impact. I think it's premature for us to say one way or another at this point. So, give me a, bring me somebody from the future to say how long this is going to last, how long oil prices stay high. I could more easily answer that question.
And needless to say, there's so much uncertainty about the war, the Strait of Hormuz. Is there anything you can say that you think is insightful, that you actually have a higher degree of confidence?
People are trying to figure out what this looks most like in sort of past eras, whether it's military conflicts or where we are in the economic cycle, the combination thereof. I think this does remind me a little bit of kind of the 1990 period, where we did see a spike in oil prices. We had Middle East conflicts. We had credit concerns that came as a result of the late 80s, LBO boom. And there was, the Greenspan at the Fed saying, "No, we really don't see this as having a big economic impact." Well, it ended up having an economic impact. It didn't cause a serious recession, but it did have an economic impact. We did have close to a bear market in stocks. It didn't turn out to be a long extreme on the economic side or on the market side, but in the early days of it, it was dismissed as yet another geopolitical, nothing to see here. And you did end up having both economic dislocations and market dislocations. Not extreme, not '08 like, but to me, there are shades of that 1990 period.
Right, and I think that is remembered as kind of the quote unquote good Iraq War, when HW Bush quite quickly achieved his objectives. Had a very he knew what he wanted to do, and he achieved it quickly. I think that would be quite a positive outcome. I
We
perhaps
just,
would
we
hope for.
just don't really know what the
Yeah.
objectives are this time. And um, the decision, if there is one, to sort of pull back on the part of the United States, anytime you're in an actual war, in this case, the three primary players, it's not a unilateral decision. So that's what makes this tricky as well.
Right. And also, Liz, I feel like in the economy and markets, there actually are a lot of self-correcting mechanisms. So, for example, normally if commodity spikes, then producers come in to supply that commodity. The price goes down. The cure for high
The
prices.
whoever said, the cure for high prices is high prices. That
Right, right.
that
And if there was a recession, then interest rates come down,
right.
and that will stimulate growth. And so there's a lot of self-correcting mechanisms, either natural to the market or
Yep,
through the government and central banks.
no
But
question.
it seems like in a war, it's the opposite. That bad things don't correct themselves and actually can lead to more bad things.
Again, it's sustainability here, and it's the strait. It's literally that Strait of Hormuz. That is the key determinant here of what ultimately both the economic impact is going to be, and related, what the ongoing market impact is going to be.
We will leave it there. People can find you on X at Liz Ann Sonders, and we will include the link to your work at Schwab. Thank you so much for coming on, Liz Ann.
Oh, thanks for having me. Much appreciated.
I hope you enjoyed today's episode. Interested in learning more about the Pictet AI Enhanced International Equity ETF, ticker PQNT, or the Pictet AI Enhanced US Equity ETF, ticker PQUS? Click the link in the description to learn more. Until next time.
Thank you. Just close the door.